Hi traders, today's market update will be all about this trade, right? Everyone saw it, everyone was afraid, everyone had quite a few questions about what is going on, if this trade is okay, if it is in sync with our strategies, or how we should solve it or not. Well, let's dig deeper into the volatility of crypto, into the law of large numbers, and why we are playing exactly the game we are playing. So first of all, MA analysis. Basically, MA means that it's the price that is going against you, the deepest one that is going against you after you are entering the trade. So let's imagine that we are entering trade, the price is going to some level, and then it's getting somewhere, and we exit here. So the worst price we were in was this one, and this is MAE. We need to understand it because MAE is pretty important if you want to model your strategies properly and if you want to know what you are trading and why. On this chart, you can see the MA percentage. On y-axis, you can see how much against you the price went and how it ended up at the end of the trade. And you can see that there are trades that went against us between minus 20% up to minus 80%. Actually, there were 700 of such trades in last 4.5 years. So we are really dealing with many trades that are going against us. But what is more important is how these trades ended up. Many of them ended up in a profit, and most of them ended up in much better numbers than where this MAE got. Why it is important? Because there is something that is called intraday mean-reverting characteristics of an asset. What it means is that the market is not moving from open to close with a straight line. Quite contrary, where the market is moving, that is going up, down, and basically during the day, the market is going through some mean reverting characteristics. And this is something we are taking advantage of because we are still getting questions about stop losses. Why not stop losses? If stop losses are the correct way to manage risks, to manage exits, and our answer is always follow the MAE analysis. And you can see that by far most of the trades that got even minus 60% against us or 70% against us ended up on much better profits. It means that it's not the best way to use fixed stops, as you will see on later slides. Another chart is aggregated MAE and final PNL. On the x-axis, you can see again the MAE in blocks. So for example, in this block, there are all the trades that went from minus 75 to minus 80, here from minus 70 to minus 75, and how on average these trades ended. And this is super important. You can see that most of the trades that went that far against us ended up in much smaller loss. And this is something we are taking advantage of. But of course, we are taking advantage of it on the whole portfolio level and on many trades. We don't know how every single trade ends. We only know the stats behind the market and the stats behind MAE versus final PNL analysis. And here it is really pretty obvious. Basically, there are not basically there are no trades on average that ended below minus 30% loss. Again, on average, based on these groups. There are some of them on the individual basis, but if you look at the whole groups on all these blocks, there are none of them which ended below minus 30%. And that's something we are again taking advantage of, and it's something what we are trading. Okay, and now the stop losses. Let's look at the different levels of stops and the impact to the performance of the portfolio. 10% stop, 20% stop, 30% stop, 50% stop, and trading without any stops. You can see that the smaller the stop loss, the worse result. By far, the difference is huge here. Why? Because firstly, we are not taking advantage of this intraday mean-reverting characteristics. And second, we are not giving the market enough space to play the edges we are trading, again, over the long term. Volatility. These days, we are getting questions if we shouldn't trade Bitcoin only or Bitcoin, Ethereum only, or top 10 biggest coins, top 20 biggest coins. Well, honestly, I understand it because right now, with the hindsight bias, if we look at the charts, we can see that it would be much better to trade, for example, Bitcoin only, because it's basically the asset that is growing pretty stably these days in crypto. Most of other assets are going sideways or are in a pretty strong bear market. But again, we are in crypto for its volatility. We want to take advantage of it. And if you look at the analysis of 10 days movement on Bitcoin only, and the whole crypto market, you can see that the volatility of Bitcoin is getting smaller and smaller. Why? Because Bitcoin is getting bigger and bigger. The liquidity is getting really bigger and bigger. And that's why Bitcoin as a single asset is getting more mature and the volatility is really by far smaller. On the other side, with the exception of 2021, you can see that the volatility of the whole altcoin market is more or less the same. Again, 23 is some exception. There is definitely not such a strong trend as on Bitcoin. And that's something that we want to play. We want to play the volatility, and that's why we are trading all the coins that are tradable. Let me show you some examples. On this chart, we would trade V3 portfolio with top 10 biggest coins only, some performance. Now we are adding top 20. So on this chart, we are trading top 10 only, and on this chart, top 20. The result, the difference in result is huge. Let's trade top 30. Again, huge difference in result. Let's trade top 50. Huge difference in results. Again, by the way, top 50 is something we are trading with our B3 portfolio right now. But let's look further. Let's look at top 75. Again, huge difference compared to top 50. And top 100, more or less the same as top 75. Well, honestly, if I could, I would trade the whole crypto futures universe because the volatility is something that is big advantage for us. It's something that is giving us some edge because on smaller coins, there are not so many institutional players that are arbitraging out the edges as quick as on the major coins. But those coins are already pretty small. The liquidity is low, and that's why we are sticking with top 50 coins. But you can see if you compare these ones with top 10, top 20, or even top 30, the difference in results is just huge. That's the reason why we want to trade these smaller, highly volatile coins. But on the other side, of course, there is some disadvantage, and the disadvantage is that some of these small coins can fall pretty quickly. On the other side, those coins can also grow pretty quickly. Another analysis is here. You can see 14-day rolling average daily volatility of the portfolios. This one, the orange one or yellow one, is with the volatility under 1%, pretty small one. We could get to some extreme of 2%. On the other side, top 50 or top 100 is much more volatile, by far more volatile. And it's something that sometimes is playing for us and sometimes it is playing against us, as was the case of REEF. But please, what we have to be always thinking about is the law of large numbers, because that's what trading is all about. Look at this chart. On the y-axis, you can see number of trades. Basically here, it's the start of 2020, and here we are getting to today, basically. And on the x-axis, you can see the percentage gain. Most of our trades are happening between -2 to +2%, by far most of them. But the distribution of profits is really not normalized. You can see that we are getting quite a few big profits that are 100, 200, 400, 500%. But on the other side, we are getting quite a few trades that are -40, -50, -80% even. That's part of the game. But to get to those profits, we sometimes have to go through these losses. There is no other way how to trade for those profits without going through these losses from time to time. But the average, and that's the most important part, the average is just here. It's our average trade that is more or less 2 to 3%, pretty small one. But to get to these average trades, we have to go through losses and we have to go through profits too. So please, I know that some of you are just closing some trades in profits. Well, over the long term, this game will be against you. Really, you have to go through some volatility, because with the volatility, you are not able to get to proper profits and you are not able to pay for these losses, especially when the market will start trending again. You can see it here. It was the start of 24. There were trades of plus 300, plus 400. And that was also the reason why we were in March 24 with, for example, high risk portfolio plus 120, 130% in a few short months. Of course, right now we are giving back some of the profits, but it's just a part of nature trading characteristics. We cannot avoid it. We can, you can trade some portfolio that is less volatile, for example, low risk one. There, such a REEF trade would be just a few percent against you. One more chart to law of large numbers, and this is this one. What is showing you? It's rolling window analysis, and it's showing you how long period we need to get to profitability. You can see here V2 portfolio, V3 portfolio, trend catcher, and Bitcoin, and also the percentage of profitability per the period. So per month, per quarter, per 6 months, and per the whole year. And you can see that the longer you trade, the higher the probability of getting to profits. Again, you can see, for example, on Bitcoin, that you need really much longer time to get to 100% profitability it would have to be minimum 3 years. But for example, on V3 portfolio, we are talking about 6 months, and V2 portfolio, we are talking about 12 months. Right now, it doesn't mean that we cannot get to longer period before we will get to new all-time highs. Again, volatility is the name of the game of trading, especially if you want to get above average profits. Don't forget that even the biggest fund managers are getting to periods of a few years where they are going sideways or into drawdown. We are doing our best to deliver stable profits, but for stable profits, we still need some proper environment. And this environment on crypto that we are for a 7th month is very exceptional on crypto market, but it's definitely not exceptional on all the markets. For example, on stocks, you could get in such a trending environment between 2022 and half of 2023. It was very similar. It was basically some type of range bound market. So really, you have to think about long-term game. You have to think about the law of large numbers, and you also have to think about the fact that we are trading highly volatile assets, and we want to extract the volatility and the profits, and to get with the profits to some level. And the higher the volatility we can get through, the higher the potential profits. Okay, if you would have any questions, please write me an email or ask here below the video. See you next time. Bye.